welcome to everyone who's joining us today for our webinar this afternoon. I'm Jane, I'm from the Alliance of Angels, and we are very privileged to have Matt Hulett with us today. He's going to talk about 5 questions to unleash your company's hidden power. Matt is an experienced tech executive, who's worked at both young companies, startups, not so larger startups, as well as public companies. So he's got certainly a wealth of experience, and we are very, very privileged to have him join us today. Before we dive in, I just want to mention a few kind of logistics things. If you have any questions and you want to participate in the conversation, feel free to dive in at any point in between transitions as Matt is chatting. We want to make this an interactive experience, right? So that we can all learn effectively together. But that's it, right? If you are not, if you're not chatting, you're not participating in, please put yourself on mute. So we don't really need to hear your kids, your dogs, or other folks. They may be truly adorable, but we rather they don't participate in our session today. Okay, so I'm going to share just a little bit about my organization, Alliance of Angels. And let me just go to the next slide. We are an angel investing group. There's about 150 angels in my organization. Every year we put about 10 million into 20 companies, give or take. Right? Most companies that are fundraising from us, they're looking for a total $500,000 to 1.5. And my typical check size is 250 to 500. When money comes in from us, it's usually in the form of 4 to 6 people, each person putting in 25, 50, or 100. And the sum total is 250 to 500. So we're not a fund, right? We're a group of people. We look at companies together. By the end of the day, everyone makes their own investment decision. They invest their own money. Their names go directly onto your cap table or whatever security you happen to be raising. We are sector-wise about half IT, about a quarter consumer. The rest is life sciences, hardware, energy, etc. But that's it. We are a sector agnostic investor. We're also relatively stage agnostic. It's never too early to come chat with us. And if you are ever interested in connecting, feel free to reach out. My email is at the bottom of this page. Also, if there are folks online who are interested in maybe participating as angel investor, I'm also happy to have that chat. So my contact is right down there. Please feel free to reach out. And with that, I'm going to stop talking and also stop sharing the screen. And I'm going to hand the session over to our speaker today, Matt. Matt, please take it away.
Great, thank you. Can you see my screen?
Yes, not yet. We can see you.
There we go. There we go. There we go. Can you see that?
Looking great. Look great. Thanks.
Great. Thank you so much for having me. It's a real pleasure. Again, we're going to keep this as an interactive session. I have about 10 slides, but there'll be about 3 logical places to kind of stop and have a real deep dive into what we're talking about today. And what we're talking about today is really how to really unlock your potential to be a market leader. And I'm going to interject maybe some humor, you be the judge, but I want to talk a little bit about less about me and then more about the subject matter. I had an investor the other day talk to me about what he likes to invest in. And I'd invested alongside this investor, over several different companies. And the conversation kind of ended with, you know, Matt, you know me, I invest in weird shit. And I said, I know David, and I operate weird shit. And I only say that in a little bit of tongue in cheek because, you know, my career, I've primarily done turnarounds, transformations, whether they're startups or big companies. And just give you a sample of companies I've been associated with. President of Expedia way back in the day. My most recent job was a president of Rosetta Stone, turning that around from a CD-ROM business into a digital business. And we sold that last year, actually late 2020. But I've done startups as well that have been backed by Allen & Company and Sequoia Capital and Draper. And again, this isn't the part of the slide where the speaker talks about him or herself. It's really to establish that I usually brought in when there's change required, when there's something wrong, the strategy, the capital, the team, or all of the above. And just to kind of set the tone, I also consider myself a man with a particular set of skills. I'm never called in when everything's going well. I'd love to get that call one of these days. I'm currently the CEO and president of PetMeds. We're a publicly traded company. We're an online pet pharmacy. a $450 million market cap. And again, I was brought in to turn this business around because it's been declining year over year. And so we're in the process of doing that. I show Liam Neeson because literally when I join a company, his voice is in my head. I'm a man with a particular set of skills. And this speech that he gives to his daughter's kidnapper is often in my head at the same time. And because I'm showing this slide, it was one of the reasons why when I brought into a situation, I started formulating a toolbox on how to approach problems, because I'm in a company about every 3 to 4 years and looking for some transformation. And so because I had this slide deck over time and I had these experiences, I wrote a book that we mentioned at the beginning of this presentation. And it's a real practical way to walk through how to determine if you have the ability to unlock your capability and potential as a company. So let's jump into it. So for today, it's about 10 slides. We're going to walk through 5 different concepts. We'll stop, talk about those, and then I'll give you a real world example of how I approached it. And then we'll talk about that at the end, and we'll be on time. So first, I think everyone has probably seen this quadrant before. It was invented by the Boston Consulting Group many, many years ago, about the growth matrix. What do you do with a certain company or asset given its market position? And so if I had axes showing here, you'd see market growth and market share dictating what you should be doing with different companies. So the stars is where everyone wants to be. That's high market share and high market growth. For those of you that are listening that invest in startups, you typically have the question marks. So anyone that's high growth, but low market share, and you're spending a lot of time and attention making sure that they have the right capital and team there in those situations. Then you get down below the line, and these are the less sexy ones. These are the businesses I typically take on. Cash cows and dogs. So a cash cow has usually a lot of market share, but low growth. And a dog is generally the one that everyone wants to avoid, which is low market share and low growth. And I've overlaid in, hopefully it's a little bit funny, some examples later in the deck. But you know, the adage here is obviously stars are where you want to be. You have significant scale and size and you're growing. You're able to dictate price. You've probably built a moat around your business. The startup land and the question mark side, you know, it's really about how to throw the right capital, the right team at the right time. And we'll walk through that. Cash cows, you know, in the BCG terms and Boston Consulting Group, they generally have you say, well, you should probably like harvest this asset or optimize it and use that cash either to give back in the form of a dividend if it's a public company or figure out a new adjacency to invest in. And then a dog is generally something that you want to harvest the heck out of and run out of. And so my career was always starting out on, you know, a problem. And I kind of learned this art of turnarounds and transformations when I was at a company called Atom Films, which was an early stage entertainment company back in the web 1.0 days. I was backed by Sequoia Capital, and we were in this situation where the entire world basically shut down in terms of advertising. And I had to start turning around a business when I was in my mid-20s. Up until then, I had only learned up and to the right. And I only say this because a lot of new operators out there in the market, I think, have only learned up and to the right growth for the last 13, 14 years. And so some of these examples may be helpful for those of you in the audience that are investors and have different companies that you talk to on a regular basis. So that gives us the framework of what you do today. But I always step back and think, can you turn around a cash dog or optimize a question mark? Heck yeah, you can. I'll give you some examples of what's happened in the past, but there's a lot of opportunity to not always divest of an asset that's damaged. And we'll walk through 5 ways to do that. So I do believe you can change your market position. This situation of being stuck not as a market share leader or a growth engine as a star can be changed, and I'll walk you through that today. So I developed this kind of FICO score. It's called an insight score, and it has 5 components to it. And over time, I actually started building it as a FICO score. So whether I would turn around a company or invest in a company or decide or consider taking a role somewhere, this formula tended to kind of come up, and I formalized it just so it was a way for people to evaluate their own company by themselves without having to invest, you know, a lot of money in consultants. I'm a big believer that you can be empowered as an investor or an operator to evaluate your own business. And so there's 5 variables to this equation called the insight score. Shorthand to remember it is T3PM. And the way it works is each variable, the first 4 variables, you basically add 1, 2, or 3 across the first 4 variables. The last variable, momentum, is a multiplication of the sum of those 4 variables against a 1, 2, or 3. And what you get is some indication whether you have a strong ability to change your market position. So we're going to walk through each one. I'll pause and then we can talk about anything you want to talk about before I go into my example. So the first one is TAM. And I would say the first 2 variables of the insight score are really kind of Newtonian physics. You know, you can't debate gravity. And really, in terms of total addressable market and the cousin of that variable, timing, those 2 are very difficult to influence because they're out of your influence. And so total addressable market and the associated serviceable addressable market are really important. And especially when you're trying to do a growth stage transformation or a growth company, you know, I'm a big believer that you need at least $1 billion addressable market because you need enough operating ceiling to grow. You need an operating ceiling to actually stave off competition and also find different spots to play, whether it's a persona, a customer, a firm, a size of company, however you want to slice and dice that market. Generally, you don't see many companies that can take 100% market share of a very big market. And so when you're trying to think of the next act for a company, or if it's an early stage company, where to play, you know, the biggest the addressable market, the better in my mind. And so when you're thinking about investments there, I always think, okay, is it emerging? Is it $1 billion, less than $1 billion market, or it's over $1 billion? And the higher, the better. So if it's over $1 billion, you give yourself a 3 if you want to score this along with this talk. If it's under $1 billion, a 2. And if it's still emerging, it's a 1. And again, very difficult to out-operate a small addressable market. When I was writing this book, I had the most difficult time talking about timing. And timing was the last chapter of this book that I wrote, this last section of the book I wrote. It was the one area of the book where, to be honest, I put it off towards the end. I actually started doing a lot of interviews with operators that I thought had exceptional timing. I called and Zoomed and recorded a session from the founder of Rovio that did Angry Birds, the founder of King that did Candy Crush, one of the founders of Concur here out of Washington, Mike Hilton, and others about their approach to timing. And what I found was that I should have been more stressed out because all of them basically said, it's serendipity, Matt, there's no way you can codify it or put a framework around it. So I got really depressed. And then I started probing more in my interviews. And it turns out most successful market timers, they kind of lie to themselves because there is a sense of timing in everything that they do, and they call it serendipity. But what I found out that most of them have is some sense of edge, some insight that not all of us have. It's hard to kind of codify how they got that edge. Sometimes it's somebody who's just had this problem for a long time or has operated in an existing incumbent company or market. But there are things that have come out of that discussion, and it made me realize there are some things you can look for in terms of deciding whether the timing is right for your business to take advantage of growth and be a market leader. So there's kind of 3 concepts here. One is the key piece that I found in all my research and personally is looking at a market that is small but growing. So when you go back to the total addressable market slide, and we talked about service addressable market, is there a small sliver of that market that's growing very quickly? So for example, if you think about Stripe, back in the day, I would argue that most of us probably wouldn't have invested in Stripe back in the day. There was a lot of other competitors like PayPal and Braintree that were already doing electronic digital payments. But Stripe had an insight around investing in an easy to use mobile SDK, and also small startups that were growing very quickly because they knew that the overall market and was changing very quickly. And their go-to-market approach was that small sliver, that SAM, that was growing very quickly. And so there's many examples of that as you think through in your own brains about those opportunities. But that's one aspect. The second aspect is kind of two sides of it. One is if you're trying to predict kind of an earthquake of timing, it's both looking for a technology shift and looking for a workflow shift. So the technology shift, think about something that exists today, but it just moves into a new construct. So you can say Stripe was probably something like that, maybe on-premise storage. So going from running a data center on-site, on-prem to the cloud, those are technology shifts, but you don't really have to convince people that it has to be done. It's just another way to do something using different technology. The harder one's the workflow shift. So convincing somebody to do something different than they've done in the past. And you think about many examples, I'm sure you'll think of much more as I'm starting to talk about these, is when you think about, everyone brings up the iPhone, but you think about the iPhone, the App Store, not many of us would think that the phone was the natural place with a GPS and accelerometer and all these other components to it would be a great platform to enable transportation being unlocked in your phone, like in the case of Uber or the case of food delivery. And so you think about these things that we did in the non-traditional world that actually all of a sudden we want to do in a new world. Those are things that you want to look for. And the debate is always, well, or is there a quantitative way to actually dissect that? And there are ways to do that. Locally in Seattle, I would say there's a firm called Pioneer Square Labs that does quite a good job of spinning up and killing 95% of their ideas. I actually interviewed somebody in the book from Pioneer Square Labs that talked about a market pull approach to deciding whether you should invest in an early stage company or not. It was a really interesting conversation. But I think there's a couple of things you can do. One is I call them data breadcrumbs. So I do a lot of consumer. I've done B2B SaaS. I've done lots of different markets. But one of my favorite things to do, if it's a consumer business, for instance, is look at just publicly available data and make some determinations. And then you do testing on top of that. For example, if you want to know if there's customer intent or interest, you could look at a product called SEMrush. It's free, and look at areas in which consumers are typing up intent, for example, at-home tech support, just making that up, and then just seeing if there's a lot of people bidding for those keywords. And so you want to look for areas that have high interest and high search volume, but low cost in terms of leads. If you have a lot of competition for a lead and it's very expensive, it's going to be very difficult as a young company or an existing company that wants to pivot to compete there. So that's one example of many. I think there's lots of examples you can do in B2B, but there are ways to sniff out whether timing is right or appropriate. And so when you think about the scoring of this, unclear, shifting in our favor, yep, it's good for us, higher the better. And so, if you look at and maybe talk to Meta and Facebook, maybe not the best week to be doing that. Did they make the right bet on the Oculus and the right bet to change their company name and approach and strategy and investment on the metaverse? Well, timing's one of those things where it's always perfect in the rear view mirror. But there are things that you can do, I would say, that give you some type of advantage, whether it's a small but growing market and whether there's a technology or workflow shift. It's the most difficult thing to figure out, as I think everyone's going to agree. So there's three more, and then we'll stop for questions. The track record. So the first two of TAM and timing, those are elemental. Those are hard to manufacture. No matter if you're a crazy entrepreneur or an operator or an investor that invests in crazy entrepreneurs, TAM and timing, very difficult to manipulate. But now we get into areas in which you can manipulate and you can influence. And so track record is an important one in that this is really what you've done in the past. So track record, and I've sat through like weeks and weeks and weeks of strategic planning and spent way too much money with folks wearing Gucci suits and $10,000 croissants telling me what my plan should be and what my track record should be. And it comes down to this. In terms of your track record, are you growing at unit share or revenue share against the market, against the competition. And I say that because, I think we've all been through this experience where you go through 80 slides and the punchline is hidden maybe in the 81st slide. Is the track record is, are you growing to where you should be based on your strategy? So a unit share strategy, think of that as, I'm going to grow a big base of customers because my business model depends on it. You can think about social media and getting daily active users because it's an advertising business. So you bet Facebook and Instagram are worried about TikTok. On a revenue share leadership basis, you think about the highest lifetime value against everybody else. And so you think of products that are premium, like in the consumer product goods space, you could pull out like Louis Vuitton, or you could pull out Apple against Samsung. And those are two different strategies. And so when you think about track record and you dive into it, first is, how am I doing? And the second is, well, how am I doing in a quantitative way? And so there's 4 things I look at in terms of determining track record. And majority of companies are very arrogant about their ability and track record when they can't answer these 4 questions. One is, on the customer value side, is there a disconnect between the perception of the customer and the perception of the value? Not what they're doing, but the perception of those 2 things. Second is, the competitive assessment is usually always wrong, building too many features to not map to the value perception, for example. The third is supply chain analysis. So looking at, are you an aggregator, a publisher of content or products, or a developer? So whether you're a game developer and on the App Store going direct to consumers, or whether you have a product that you're selling on Amazon exclusively and they're your aggregator, or you're somewhere in between, understanding where you are in the supply chain makes a lot of difference. You've seen some examples that have been pretty public. For example, Fortnite competing or combative against Apple. That's a discussion between a developer wanting more capability and more royalty and unit share as a margin versus the aggregator. So understanding those dynamics is really important. And then lastly, your demand strength. So what's your ability to grow your traffic, grow your volume, grow your leads if you put every net incremental dollar into that business? And so those are the 4 things that I look at in terms of track record. And again, it's when I step back, how am I doing on a unit share level or a revenue share level against the competition as the benchmark? If you're declining or treading water, something's wrong. So when I determine track record, that's something you can fix, but it's a big signal on how much investment in the future you need to make on that problem or another problem. And then 2 more to go, and then we'll stop. Then the plan. So the plan, usually comes out of the track record. So if you've given yourself the fact that, like, let's say you're tracking yourself in this, scoring it, that you have a big addressable market, your timing, you feel about right, you have a good or bad track record, that's okay. But how's your plan? And plan is usually the area where I find that most companies have a lot of hubris. And I look at 4 different things with my plans are, am I selling more to the same customer? And that could be more products that I'm going to expand. If I'm going to do like an expansion strategy of a small, department in a company and grow it, are there more incremental products I can sell? Are there other types of business partnerships I can do? For example, cheap and cheerful is what I call it. So for example, I'm in the pet space now. Are there ways that I can sell insurance? I'm not going to invest in that. I'm not going to be an insurance company, but maybe I could do a partnership with an insurance company and get in that incremental EBITDA without having to build it. There's lots of ways to sell more to the same customer. Most companies don't spend enough time on that area. The more expensive one is to sell new products to new customers, or just sell new things to new customers. That's when your customer acquisition costs are the most. You could also think about going into new geographies with the same product, but new to new customers is obviously an area that a lot of companies focus on and don't spend enough time on as well. The last 2 are more demand. Again, similar to the previous example, can I spend more money differently to get dramatic results? So not just spending more money, but also earned media. I think about how Zillow went to market with the Zestimate and their attitude about not spending money on paid media, using PR and a feature to get more demand. It's not always spending more money on AdWords. And lastly, I always say, hey, when the kitchen's hot, when the plate is hot, start cooking. So if you have a business that has a lot of capital and you're a little concerned about execution, you can always buy stuff. I'm a big fan of, for example, M&A tuck-ins. If there's a capability that you need and you can finance it, maybe a little harder now for debt financing because interest rates are going up so much to underwrite. But if you can buy something that accelerates your capabilities, certainly do it. When I was at Expedia, I spent about 5 years at Expedia. The name of the game in travel, for instance, was, and still is, supply the biggest scale across the biggest number of customers, because you can amortize your fixed costs and also negotiate with your suppliers to get the best deals. We went on a buying spree, and it's still around, obviously, with hotels.com and TripAdvisor and Agencia and all these names that we collected under an umbrella brand, a conglomerate, an inorganic strategy to get more brands that get more control over the supply chain so we can spend more money on demand. Great way to do it. And so lastly, if you've scored along the way, you give yourself a 1, 2, or 3, you add those up. So for example, if you're perfect, you'd be a 3, 3, 3, 3, you'd be a 12. And then momentum, this is the accelerant. And so you can have the best ideas, but if you can't get the team and the capital, it really doesn't matter. And that's why it's so important. I don't find many companies that have, really good, big addressable markets with great teams that are growing and have great plans to not get the right team and capital. But it does happen. And so I find that the components in which you break down a team into the right person at the right time, at the right stage, is really important. If you're an investor or an operator on this webinar, I think of acquisition and team management as one of the most important things you can do, especially as a C-level executive. I make all my teams think a couple of years out, even in early stages, about the heads and the people you may need, not the individuals, but the type of capability you'll need. Understanding when to hire the next salesperson, super important based on the growth of your business. But being able to scale through people at the right time and stage is not just an art, it's a science. And you can do it doing 9-box succession planning, thinking thoughtfully about your organization, making sure you're hiring people that map to your values. Those are all very important things that can be codified and they can be tracked. And if your companies aren't doing employee satisfaction surveys every quarter, you need to flag that. If you're not doing skip level discussions with your managers, got to flag that. And so in this day and age, especially with more hybrid work and remote first working, don't get me started on quiet quitting. It's very important to assess quantitatively as well as qualitatively, do you have the right team at the right time? And then usually capital, there are some people that are just really bad at raising capital, and you need to identify that. If you're an operator that isn't great at it and you're staring at your shoes, it's like one of my old business partners was a Finnish guy, still is a Finnish guy. He used to always stare at his shoes when he'd pitch raising money. It wasn't like the best way to pitch, just staring at your shoes. That's a thing to flag as well. The ability to get capital and team is that momentum changer. And so those things combined generally mean that if you get above a 20 when you're scoring along at home, you have a really good shot of unlocking value. The areas in which I flag where I feel like, you can't change the assets if it's an investment that feels a little long in the tooth, and it has like addressable market and timing not going well for it. Those are just very difficult things to change. I have an example that I can walk through in a second, but I want to stop there and see if there's any questions. I do not see any chat, and I'm going to keep going. If you have any questions, just put them right in the chat. So, recent example. As I mentioned, I'm currently the CEO of PetMeds, ticker PETS, PETS. just recently, last year, I was the president of a company called Rosetta Stone, a language learning company. I thought it'd be helpful just to walk through how we scored that business and kind of go through the thought process. So Rosetta Stone, again, back to the Liam Neeson example, was one of those where people basically, some of my mentors were basically kind of calling me the Mikey of the internet, like, hey, Mikey will eat anything. And a lot of people were making fun of me for taking on this one. It's a dinosaur. That's your grandfather's language learning product. I mean, the level of ridicule was pretty high on this one. And I thought it was pretty fascinating for a bunch of reasons that we'll get into, but I want to stop because John has a question. Running through the scoring process again would be helpful, please. Yeah, I'll stop there. Actually, let me use Rosetta Stone as an example. So Rosetta Stone was a dog. It was not growing. It didn't have high market share at the time that we took it on, and it wasn't growing, and there was a lot of problems. It was like kind of like a babushka of problems, meaning we were a small cap business with 3 business units. Each one of those had different growth rates and had a bloated cost structure. And it was just reeking of being one of these sum of the parts analysis, meaning it's probably worth more ripped apart than actually together. But the business couldn't actually be transacted in providing value to the shareholders and to the potential acquirers until we started fixing some of these assets, primarily the language business. So John, I'll walk you through kind of how I scored that, and that may be helpful in a real world example. So the inevitable score was 24. And let me walk through the scoring of that. So when I go back to the language learning example, and there are some comps you can look at if you're interested, like Duolingo is a public company you can look at. You know, I was faced with, again, a lot of ridicule. And when I went into that one, I kind of walked through those 5 steps. So the total addressable market for language learning is somewhere around $50 billion with a B, very large. And diving into the addressable market, there was a lot of geography considerations to think about. There was not a consistent way in which different consumers or companies would learn languages across different geographies. So as I started noodling on this, I started thinking very quickly that most of what would be required is a geography focus versus trying to take the same product everywhere. There's some examples where that did work, like Duolingo, but that was kind of the analysis. So it's a $50 billion market. And oh, thank you. Yes, I got the reference wrong, but thank you for correcting me on the babushka. So the addressable market was really large. And so the addressable markets that we were in just about every market: the K-12 education market, the corporate market, the consumer market. We're in all 3 of those and primarily concentrated in the United States. But overall, even if you looked at the United States only, really big market with a B. So we gave that a 3. And the second component in terms of timing, there was a huge shift from offline tutoring, especially in Asia and outside the United States, but also in the United States, of people wanting to use more apps. There was a lot of already upstarts like Babbel and Duolingo in the market, and they were growing really, really rapidly. And so there was no question that the timing was right. And this is like in the late 2017 era. And then it got even more pronounced during the pandemic, where everyone at home wanted more things to do other than Netflix. So timing was off the charts. It was a 3. The plan itself, then track record, declining market share, lots of different strategies. Nothing was really working. So we gave that a 1. In terms of the plan itself, there was kind of a not a great plan. There wasn't a plan to really do much at all. In fact, one of the big shockers in that business to me was the focus on the enterprise business. So selling language services to companies, which was a focus for the business. And they weren't really great at it. It was like a B2B SaaS business where they weren't really good at B2B SaaS. And it was very long sales cycles. And actually, when you close one of those deals, it was one of like the first things that companies would cut if there was a recession or a downturn, because it wasn't critical. So to me, I was really worried about that focus going into the business. And one of the obvious things when I evaluated the 4th variable plan was no one really looked at the consumer business. The consumer business, when I started Rosetta Stone, was left to die. And I thought that was odd for a company that had 97% unaided awareness. And that's an asset that was built over many, many years of building a brand. And not only just a good brand, but a brand that customers still liked across lots of different age groups. And so the strategy with that one was to go in and actually invest more in the consumer business, reinvigorate the team, change the product, actually have a mobile product that was good, and then invest into it, but focus on a market segmentation around premium. So we decided not to follow Duolingo into free, but actually focus on the premium end of the market and go after customers that really viewed language learning over the lifetime of their customer experience. And so that was a segment of the market that was about a third of the overall language market, which kind of gets us the capital momentum. Is we could self-finance this venture because we had other cash flows and we had a great team that we brought in, some from my previous lives, some were from the company. And overall, we kind of landed on a 24. It wasn't like a super high score, but I felt really with the right team and the brand in particular, with that focus on go to market for the consumer business, that we could pull out a good outcome. And so that was a very difficult turnaround as a public company, but it went from like a $200 million market cap to about 800 million exit in about three and a half years. A lot of luck involved, and I certainly had very little to do with it. It was very much around having a good team, but that's an example, John, of your previous question, how I would score something with a real world example. I hope that was helpful. So let me answer some questions here.
Very much, thanks.
You got it. So Tom, what's the formula for the score again? Yeah, so the first four variables, TAM, timing, track record, and plan, it's 1, 2, or 3, 3 being the highest. You want the highest. You add those up. So the perfect score would be 12. And then you multiply that number by 1, 2, or 3, which is your momentum. So perfect score is 36. Yeah, that. And so, you know, I've had a lot of my friends who are super quantitative data scientists are like, why is momentum the accelerator, and should it be this exponent versus that exponent? It's folksy, but it's folksy because I think that a lot of people over-index on total addressable market only, and so I try to mute that a little bit in the formula and really focused on the capital and the team component. Another question, organic foods. Okay, I will. I think I got through those questions. Any questions, I'll stop here that I can answer. Okay, I don't have much more in terms of slides. That's kind of the insight score in a nutshell. And I really developed the formula and the approach because I really was sick and tired of sitting through these multi-week strategic planning sessions where I always felt like I was overcommitting on initiatives and capital to too many things and bringing too many outsiders to help really give me an insight on what I felt like the team and I could do. So I affectionately wrote this over 3 months. It took a year and a half to kind of get the graphics right and the editing and stuff, but you know, it's a slide deck, and I had the slide deck on my wall that I've been using for like 20 years. And then I started building the score around that just so that I could give back a little bit, because I feel like at this day and age, there's a lot of younger operators of businesses that may not have been operating through a downturn. And I was just a colloquial comment, and we'll open up for more questions. I didn't know that either. And when I was in my mid-20s at this startup, and my career progression was a company here in Seattle called WRQ, then startup called Progressive Networks that became RealNetworks pre-IPO. I was the product manager for a product called the Real Player. And then I went off and tried to be a startup executive. One of our board members was Mike Moritz, who those of you probably know him, who's one of the best known investors, I think, around, but was at Sequoia Capital, is at Sequoia Capital. And when that downturn happened, Sequoia was very famous for, and they've subsequently done multiple versions of this slide deck. He did a slide deck called Web 1.0 RIP. And he was on our board, and he was one of our investors. And literally the person that kind of taught a whole generation of operators how to run businesses through downturns was my board member and had this deck, and literally was the person scrutinizing my plan to get this business through a downturn. Eventually that company was bought by Viacom, certainly not the IRR that I think Sequoia would have wanted, but it survived and did get purchased by Viacom. And what I learned from that was understanding how to be a little bit more holistic about and thoughtful about capital allocation. So that's a little bit of background on what kind of drove me to write this book. Let me answer a couple questions here. Was your experience turned out to be, what in your experience has turned out to be one of the biggest snakes in the bag, so to speak, something that you didn't anticipate, could have or did bite you, and that you've encountered in some of the turnarounds that you've done? And sorry if I look a little strong, a little weird, Robert. I've got my trifocals on, so I have to kind of crease my head differently. Biggest snakes in the bag. You know, I think the biggest snake in the bag that I learned to not really try to change is a bad cap table. Taking on a company that just has an unfavorable cap table to the management team, it's just very difficult. Or net new investors. I'm sure those of you that are listening that are probably all investors know this. The second I would say is hiring. And I don't do this anymore. It's kind of a subscribe to the hire slow, fire fast, you know, trying to turn around somebody that isn't the right fit, is passive aggressive, isn't, or is actually was the right fit that isn't the right fit anymore, and not acting on it quick enough. I think those are some of the snakes in the bag. It's an interesting question. Lessons learned and any advice on processes learned to better look around the corners in the future. Yeah, so I'm not a big fan of the annual anything. So annual best places to work, although we do that survey for primarily recruiting reasons, but we do, you know, quarterly everything. And so quarterly planning, I use a process called V2MOM, which I basically stole from Salesforce.com. V2MOM is a framework called Vision, Values, Methods, Obstacles, and Measures. And it's a framework that we basically write no more than 3 or 4 goals in a quarter with KPIs against. And we constantly look at them. In fact, we try to tie everything we do on an annual plan to the quarter, to the month, and to the day. We have actually sheets that are in Google Docs where we're at every level looking at what we're doing against those different methods. So for example, growing your revenue to some amount, or selling more to the same customer, or some new infrastructure that you want to build. And we have specific goals against that, and we're constantly discussing it. And so seeing around the corners that way has been helpful, because a lot of teams get locked into the worldview of, my plan is the plan, no matter what happens on a Tuesday, Monday and Wednesday are still great. And so I try to keep things planful, meaning you have a plan, a well-intended plan, and you work back from that and make sure that you're constantly having that discussion of, when you see, you know, a lot of red, step back and understand what's the red on your plan. Is it that there's new competitors, customer acquisition costs going up because, in my case, Chewy's in the market and they're doing something egregious, or, you know, understanding how the organization is working and have that fluid, I think, is the best way to look around those corners. There's other things to do, but I think that's been really helpful for me, is to make the planning process dynamic and make it a team sport. So when I get, next question, so when you get called in to turn around Twitter, how will you score them? What a fascinating acquisition. Probably the most, probably paid $30 billion too much. Let's leave it at that, Brent. yeah, I've never actually done a first week like Elon has done. I usually take about 90 days to do team and strategy and process evaluation. And that's usually a report that I give a board and or the investors. I call it the good, the bad, the ugly. And I have a Clint Eastwood poster from the good, the bad, the ugly. And I walk through in that format. I actually play the music just to lighten the mood a little bit. Sometimes it's not a light mood. But yeah, very interesting, huh? Yeah, kind of crazy to watch. Really good questions. We have some more time. Quick question on TAM from a startup lens. At Genesis Blueview, we invented biodegradable polyurethane and built the world's first compostable sneaker. Very cool. If we look at TAM and petroleum-based plastics, it's a massive multi-billion space. If we look at TAM through a bioplastic lens, it's much smaller. Thoughts? Yeah, I think I view it as, what does the consumer buy, or what does the business buy? And so in that case, let me think through this. It's, I think, what is the customer and how do they view it? That's how I'd view the addressable market, because I've seen this before in the renewable space where they're trying to tie a couple of different trends and determining what the addressable market is, or sometimes the data isn't matching because there's two different things going on. And I always go back to, what is the customer buying? So for example, my wife's the CEO of a non-alcoholic beverage company. She's always struggling with, okay, the non-alcoholic beverage business is X, non-alcoholic beverages have all these different addressable markets. There's beer, there's wine, there's alternatives. And we just went through a session recently where I said, look, what does the customer think they're buying related to your product? And so she really centered in on the wine alternative space, given how her customer perceives the experience that they want. They want a wine experience. Her product is not made from grapes. So she had, to give you an example that's not your business problem, but I pushed her to think about, what is the customer actually, what's their pain and what do they think their pain is? And then attach the addressable market related to that. Because I think a lot of times when people are trying to figure out, like you are innovating in a space with multiple addressable markets potentially there, it gets very complicated. And I think if you just dial it back to what you think the addressable market is based on the persona and the need, you kind of get to an answer. So I use the non-alcoholic example as an example where she was trying to tie everything against beer, wine, cocktail alternatives, where really her customers are people, and usually women of a certain age range, socioeconomic. She knew the customer profile. They knew the experience they wanted, but viewed her product as a wine alternative. So it was very helpful to kind of go through that. And maybe that's helpful for you. Twitter's going to make one hell of a case study. Absolutely. I've posted on LinkedIn a few times about it recently because it's so fascinating from a leadership and management standpoint. 100%. Scott Galloway, many of you may know, is pretty vocal about Elon these days. It's interesting to listen to all that. I still share on Twitter and find it useful just to keep it alive. Great input, man. Thanks. You're welcome. Thanks, Tom. Yeah, I thought it was really classy how the former CEO of T-Mobile interacted with Elon when he basically asked for the job live on Twitter. I thought that was an interesting interaction. I think we have 10 more minutes. Yeah, I'd love to check out Blueview footwear. I'll definitely do that, Tom.
Okay, so Matt, thank you very much. Thanks for the session and thanks for answering all these questions. If there are no other questions from our audience, I think we can probably call it a wrap for today. I see Matt has shared his contact information. And if you want more details into his framework, I'm sure you can purchase his book. It's available on Amazon, right, Matt?
You got it. And if anyone wants to DM me, I have the slide deck I actually use They're kind of like a template, the 10, 15 pages that you can actually use with your teams. I'm happy to send that to you.
Thank you very much, Matt. And for the folks who joined us, if you sign out the Eventbrite, we will also be following up with the presentation, right, that Matt walked through today. So, but if you join kind of impromptu, right, certainly follow directly Matt for the materials. All right. And so with that, again, I'd like to thank Matt for spending time with us this afternoon, sharing all his insights, his analysis, his years and years of experience. So thank you very much to you. And also thank you to everyone for participating and making this a great session for everyone.
And thank you so much. Have a great early Thanksgiving, I guess. It's not there yet.
Yeah, we are creeping up on it, but thanks. Thank you to all. Have a great rest of have a great weekend.
Thank you so much.
Thanks. Bye-bye.
Bye.
Bye.